Welcome to this deep dive. We've pulled together a stack of recent reports, interviews, and analyst notes that are painting a really fascinating picture of some major shifts happening right now in the tech world.
Yeah, think of this as your essential briefing. We're going to unpack the pressures on a giant like Apple over, where it actually builds its products. And some surprising signals about how tech companies are getting funded and going public in this market.
Right.
And also that critical race for the advanced skills we need for the future, especially, obviously, with AI.
So our goal is really to cut straight through the noise, pull out the key insights from all this material, and give you a real handle on these interconnected trends. Quickly, painlessly. Ready to jump in?
Let's do it.
Okay, let's start with Apple then. The reports lay out some pretty direct government pressure. We're talking the threat of a significant 25% tariff if they don't ramp up production right here in the U.S.
Yeah, and what's interesting is how public this has all become. Some analysts looking at it, they feel Apple has been navigating these talks, well, maybe badly is the word they use.
Badly?
Compared to who? Compared to other tech CEOs who seem to make quicker public commitments. There's one view calling this whole period a bit of a humbling week for Apple, actually.
Humbling how?
Well, you factor in things like Google's big AI announcements at I.O., the OpenAI and Jony Ive news. It all adds up to maybe a less dominant spotlight for Apple recently.
Okay, right. And you can see the immediate market impact, can't you? Apple shares took a bit of a knock. It's seen as a definite headwind for them this year.
Exactly. But, Apple hasn't just been sitting there. They've already been making strategic moves, shifting some iPhone production out of China.
To India, right.
To India particularly, yeah. And that's explicitly to try and get around some of these tariff issues and the costs that come with them.
But the core problem with bringing it all back to the U.S., it's not just cost today, is it? It's the reports emphasize this lack of a ready, high-skill workforce.
And the whole supply chain ecosystem around it.
Yeah.
We've seen examples before, like remember the Foxconn attempt in Wisconsin?
Vaguely, yeah.
Well, it really struggled, and part of that was just the difficulty finding the specific talent they needed. It's not just putting parts together now. Modern manufacturing it's sophisticated stuff.
That skills point is really key, isn't it? Because while building iPhones here right now sounds incredibly expensive, the reports do float this idea that maybe in, say, a 5-year time frame, if Apple really commits, it might not actually be that much more expensive.
It's an interesting possibility.
Yeah.
And you have to look at Apple's resources here. I mean, the reports highlight their huge financial strength. What is it? $50 billion cash on hand?
Something like that, yeah.
And generating $100 billion a year.
Right. So that kind of capital, it's described as enough to accomplish great things. And that absolutely includes developing that domestic skill base, building the infrastructure, over time.
Okay, but what about those crazy numbers? I think I saw something estimating like $3,500 to make an iPhone in the U.S. Oh, yeah. The analysts we looked at pretty much dismiss that. They call it not a real thing.
Yeah.
The more sort of realistic scenario they discuss is maybe absorbing that 25% tariff from somewhere like India, if needed. Either through slightly higher prices or maybe just thinner margins for Apple if U.S. manufacturing doesn't scale up fast enough.
So the strategy they're suggesting is Apple has to do both things at once.
Essentially, yeah. Walk both paths. Keep negotiating, maybe absorb some short-term tariffs, but at the same time, make those really substantial long-term investments in that 3 to 5 year vision for U.S. manufacturing.
Because this isn't just a temporary spat.
Exactly. The bigger picture here, according to these sources, is that companies everywhere are having to adapt to pretty significant lasting changes in how global supply chains work. It's a geopolitical reality.
Sounds like a forced inefficiency, though. I can imagine investors might find that frustrating.
Oh, absolutely. But even if Tim Cook is seen as a skillful enough negotiator, navigating these complex demands and investing for a different kind of supply chain future, well, that's just part of the new game.
And that challenge for Apple, the where things get made, connects right into the who makes them. Which brings us to our second theme, that critical U.S. skill gap.
Right. For advanced manufacturing, for tech competitiveness generally, the sources are really clear. Building the talent base we need here, it's not a quick fix. It's going to take years.
And why so long? Because, like you said, modern manufacturing, it's not the old assembly line.
Not at all. You need high-skilled people who can work with complex robotics, sophisticated software, advanced processes. It's a different ballgame.
And right now, that deep pool of talent, where is it?
Well, the sources point mainly to places like China, Taiwan, Japan, South Korea. especially when you get into the really cutting-edge stuff, like making semiconductors.
Okay, so just trying to import talent has its own issues, which means working closely with allies who do have those skills becomes really important.
Crucial. But the reports also really push for strong domestic investment. Things like supporting U.S. universities to churn out these graduates and making it easier for high-skill immigrants to come here. Both are framed as basically non-negotiable if America wants to stay competitive in these advanced tech fields.
There was one point I found really interesting about open research, like the stuff funded by the National Science Foundation.
Uh-huh.
The idea that even though the results are published globally, the country doing the research in this case, the U.S. still gets the biggest benefit.
How so?
Because the knowledge just spreads faster and deeper locally. It gives you a head start in actually using it, innovating with it, faster diffusion domestically.
That makes sense. An implementation advantage.
Okay, let's shift gears a little, though it's still connected by this need for talent and, well, money. The IPO market, what are the sources saying there?
Yeah, the phrase that keeps cropping up is that it's creaking open.
Creaking open. Not exactly throwing the doors wide, then.
No, definitely not the sort of frenzy we saw back in, 2021? But companies that either really need the liquidity or maybe just have a very strong story to tell right now, they're finding ways to go public.
And we've seen some examples.
Yeah, companies like eToro, Hedge Health, Mountain, they've managed successful IPOs recently. And some have even done okay, post-listing in the market.
So what's common about these companies that are managing to get out?
Well, it's interesting. According to the sources, they're often older companies, sometimes like 10 years old or even more.
So it's a liquidity time for early investors and employees who've been waiting a while.
Exactly.
Yeah.
That's a big driver. And surprisingly, some haven't even been profitable, though usually they're close to breaking even. But they still tend to have high growth rates, like 35% or more revenue growth seems common.
Okay.
And here's a key thing. Many are down round IPOs.
Meaning they're going public at a lower valuation than their last private funding round.
Precisely. Especially if that last round was during those peak valuation times of 2021. It just shows how the market's kind of resetting expectations.
So if that traditional IPO path, that sort of 10-year fund timeline, isn't working reliably anymore, how's that changing venture capital itself?
Well, this is where the secondary market has just become huge. It's not some niche thing anymore.
Selling shares privately before an IPO.
Right. There was a really striking stat from Precursor Ventures expecting, get this, like 75 to 80% of their future distributions back to their investors.
Wow.
To come from these secondary sales. That number really tells you how big the liquidity challenge is and where VCs are actually finding exits now.
So VCs are having to adapt their own structures too. I heard something about them becoming RIAs, registered investment advisors.
Exactly right. Firms like Lightspeed, for example, have recently structured themselves as RIAs. And what that does is it gives them more flexibility than a traditional VC fund. They can invest more than just a tiny fraction of their fund into public companies. And crucially, they can more actively participate in these secondary markets.
Gotcha.
And remember, it's not just the sell side. VCs needing cash, employees running out. There's a big buy side too. Funds or companies with lots of capital are using secondaries to get into deals they otherwise couldn't, like those really hot, oversubscribed AI startups.
Access to the otherwise inaccessible. Makes sense.
And speaking of AI, that brings us nicely to the last quick theme running through these reports. The AI race.
Yeah, you can't really avoid it, can you? We've had big updates recently. Google I/O, for instance.
Right, showing off their new AI mode for search, more on Gemini, talking about AI agents, even looking at subscription models for their top-tier AI stuff.
And the whole competitive landscape, it's often framed as this intense arms race, isn't it? Particularly U.S. versus China.
Yeah, one source described it really vividly as a marathon.
Yeah.
But a marathon you have to run at a sprinting pace.
That's a good way to put it. Intense pressure.
And one little detail that really jumped out at me was about DeepSeek's new model. Reportedly, their training cost was remarkably low.
How?
Like $5.6 million. Which, when you compare it to the huge numbers sometimes estimated for training competitor models, it suggests that efficiency, how smartly you build and train these things, is becoming a really key factor. It's not just about who can spend the absolute most.
Interesting. Smarter, not just bigger.
Oh, could be.
Yeah.
And just to tie it back to funding and talent again, you see someone like Andrew Ng launching a new AI fund. And it's pointedly targeting startups, mainly in the U.S., but also looking across Asia. It just shows you where those global hubs of investment and development really are right now.
Okay, so let's try and bring this all together. We've kind of navigated through this really complex landscape, haven't we? You've got geopolitics hitting corporate strategy for huge players like Apple.
Right.
Then there's that fundamental challenge of just finding and developing the right kind of advanced skills here at home.
Absolutely critical.
And then these shifting sands in the financial world, changing how tech companies get funded, how they grow, how they eventually provide returns from startup to IPO or secondary sale.
Yeah, and understanding how these forces are all interconnected, that's really the key, isn't it? To grasping the bigger picture of where tech is heading and why certain things are happening right now.
Definitely. It kind of leaves you with this final thought to chew on, maybe, as you've got national policy pushing one way, global talent competition pulling another, and capital flowing in these new patterns. How are all these pressures ultimately going to shape who wins? Which companies, which countries end up leading that next big wave of tech innovation?
Yeah, that's the multi-billion-dollar question, isn't it? A lot to think about there.
Indeed. Well, thanks for joining us for this deep dive.